The Rich Plan, written and published by Rich Audiobooks. Hope is not a strategy. If you want to be rich, you need a plan, not just dreams, but direction. The Rich Plan is your blueprint for intentional wealth, clear steps, aligned actions, and the mindset to sustain success once it arrives. Are you still winging it with your future, or are you ready to design a life where your money, time, and energy work for you, not against you? This isn't about getting rich quick, it's about getting rich with purpose. In a world full of distractions, the Rich Plan is your guide to staying focused, building real freedom, and living with powerful intention. Because without a plan, you're just guessing, and the rich never guess. Lesson 1. They start with a vision, not vibes. The wealthiest people share a common starting point that separates them from those who merely dream of financial success. They begin with a crystal clear vision of their financial future. This vision isn't a vague notion of being rich or living comfortably. Instead, it's a detailed mental picture of their desired financial reality, complete with specific numbers, timelines, and lifestyle elements. Consider the difference between someone who says, "I want to be wealthy," and someone who declares, "I want to build a $2 million 0-cents investment portfolio that generates $80,000 0-cents in annual passive income by age 45, allowing me to work on passion projects while maintaining my family's current lifestyle." The first person operates on vibe fanning, baseless, undefined aspirations that provide no concrete direction. The second person has created a vision that serves as a precise destination, making it possible to chart a course toward that goal. This clarity of vision becomes the foundation for every financial decision that follows. When faced with investment choices, spending decisions, or career moves, the vision serves as a filter through which all options must pass. A clear financial vision transforms abstract choices into binary decisions. Either something moves you closer to your vision, or it doesn't. This simplification of decision-making is one of the most powerful advantages of starting with a well-defined vision. The process of crafting this vision requires honest self-reflection and careful consideration of what truly matters. Smart wealth builders understand that their financial vision must align with their personal values and life goals. They recognize that wealth isn't the end goal, but rather a tool to create the life they desire. This might mean having the freedom to start businesses without worrying about initial profitability, supporting causes they believe in, or ensuring their children have educational opportunities without the burden of student debt. Your vision should be ambitious enough to inspire action, but realistic enough to be achievable through consistent effort. The most effective wealth builders regularly revisit and refine their vision as their circumstances and understanding evolve. They treat their vision as a living document rather than a set-and-forget statement. This dynamic approach allows them to incorporate new opportunities and adjust for changing market conditions while maintaining their core financial objective. The difference between a vision and a vibe becomes particularly apparent during market downturns or personal financial challenges. Those operating on vibes often make emotional decisions based on fear or short-term thinking. In contrast, those guided by a clear vision can weather volatility with confidence, knowing exactly why they're investing and what they're working toward. This emotional resilience is a crucial element of long-term wealth building that only comes from having a well-defined destination. Creating your vision requires more than just picking numbers out of thin air. It demands research into realistic return rates, understanding of tax implications, and consideration of inflation's impact on future purchasing power. Smart wealth builders spend time studying those who have achieved similar goals, learning from both their successes and mistakes. They use this knowledge to create a vision that's both inspiring and grounded in financial reality. The power of a clear financial vision extends beyond personal motivation. It becomes a tool for communicating with financial advisors, business partners, and family members. When everyone involved understands the destination, it's easier to align efforts and make collective decisions that support the overall wealth-building strategy. This clarity of purpose often attracts opportunities and like-minded people who can contribute to your financial success. A well-crafted vision also serves as an antidote to the constant noise of financial media and market movements. Instead of being swayed by every new investment trend or market prediction, those with clear visions can stay focused on their long-term objectives. They understand that sustainable wealth creation isn't about chasing the latest hot stock or cryptocurrency, but about steadily moving toward their carefully defined goal. Chapter 2. They build income streams, not dreams. The foundational difference between those who achieve lasting wealth and those who merely wish for it lies in their approach to income generation. While dreamers fantasize about sudden windfalls or viral success stories, strategic wealth builders focus on creating multiple, reliable streams of income that flow consistently over time. The wealthy understand that depending on a single source of income, typically a job, is like trying to fill a swimming pool with a garden hose. Instead, they approach income generation like designing an irrigation system, with multiple channels feeding into their financial reservoir. They start by mastering their primary income source, often their career or main business, and then methodically add complementary streams that align with their skills and available resources. These additional income streams typically fall into 4 categories: earned income from active work, passive income from investments or royalties, portfolio income from capital gains and dividends, and business income from enterprises they own but don't necessarily operate day to day. The key is not to pursue all categories simultaneously, but to strategically develop them one at a time, ensuring each stream is stable before moving to the next. Of taking what they already have. Successful wealth builders often begin with their expertise. A marketing professional might start consulting on the side, a teacher could create and sell educational materials, or an accountant might develop a specialized tax preparation service for a specific industry. They leverage their existing knowledge to create value, rather than attempting to master entirely new fields from scratch. The transition from single to multiple income streams requires careful orchestration. Smart wealth builders treat each new income stream as a separate business unit with its own growth strategy, resource requirements, and success metrics. They understand that not every attempt will succeed, but they approach each with the same level of analysis and planning they would apply to a full-time business venture. Technology and digital platforms have dramatically expanded the possibilities for income stream development. Online marketplaces, subscription models, and digital products have created opportunities for scalable income that weren't possible a generation ago. However, wealthy people don't chase trends. They evaluate these opportunities through the lens of sustainability and long-term potential. The wealthy also recognize that some income streams require more initial effort but offer greater potential for automation and scaling. They might spend months or years building a system, product, or investment portfolio that eventually requires minimal maintenance while generating consistent returns. This front-loaded effort distinguishes them from those seeking quick, easy money. Diversification across income streams serves another crucial purpose: risk management. When one source faces challenges, whether from market conditions, technological changes, or other external factors, the others can help maintain financial stability. This resilience allows wealthy people to take calculated risks and capitalize on opportunities without jeopardizing their entire financial foundation. The process of building multiple income streams also creates valuable feedback loops. Each new venture provides insights and connections that can strengthen other income sources. A rental property investor might discover opportunities in real estate development, while a successful online course creator might identify consulting opportunities with corporate clients. Smart wealth builders approach income generation with patience and pragmatism. They understand that sustainable income streams rarely materialize overnight, and they're willing to invest the time and resources necessary for long-term success. Rather than being swayed by get-rich-quick schemes or temporary trends, they focus on creating value that customers or markets will consistently pay for over time. Chapter 3. They reverse engineer freedom. Financial freedom isn't a vague dream. It's a mathematical reality that can be systematically deconstructed and achieved. Smart wealth builders understand this fundamental truth and approach their journey by working backward from their ultimate goal to their present position. The first step in reverse engineering your freedom is defining what it means specifically to you. For some, freedom means having enough passive income to cover basic living expenses. For others, it represents the ability to travel extensively, support charitable causes, or provide generational wealth for their family. This personal definition becomes your destination coordinates, the exact point you're navigating toward. Once you've crystallized your version of freedom, you can calculate your freedom number, the amount of wealth required to sustain your desired lifestyle indefinitely. This calculation considers factors like annual expenses, inflation rates, investment returns, and life expectancy. A common starting point is multiplying your desired annual income by 25, based on the 4% withdrawal rule. However, sophisticated wealth builders often adjust this figure based on their risk tolerance, market conditions, and specific lifestyle goals. With your freedom number established, the reverse engineering process begins in earnest. Think of it like planning a cross-country road trip in reverse. You start at your destination and work backward to identify major milestones along the way. These milestones become your wealth markers, specific asset levels that indicate you're on the right path. For instance, if your freedom number is $2 million, 0 cents, you might set markers at $250,000, 0 cents, $500,000, 0 cents, $1 million, 0 cents, and $1,500,000, 0 cents. The next phase involves breaking down these markers into annual, monthly, and even weekly targets. This is where reverse engineering transforms abstract goals into concrete actions. If you need to accumulate $500,000, 0 cents over the next 10 years, you can calculate the required monthly savings, expected investment returns, and additional income streams necessary to hit that target. This granular approach makes the journey manageable and measurable. Smart wealth builders understand that reverse engineering also reveals resource gaps that need addressing. Perhaps your calculations show that your current income can't support the necessary savings rate. This insight might lead you to develop new skills, seek better employment, or create additional income streams. Or you might discover that your investment strategy needs to deliver higher returns, prompting you to reassess your portfolio allocation. Progress tracking becomes natural when you've reverse engineered your path to freedom. Rather than wondering if you're moving in the right direction, you have clear metrics to monitor. This might include tracking your net worth, passive income growth, savings rate, or investment returns against your predetermined markers. These measurements provide feedback on whether you're ahead of schedule, on track, or need to make adjustments. The reverse engineering approach also helps maintain motivation during the wealth-building journey. When you understand exactly how each action contributes to your freedom goal, it's easier to make smart financial decisions. That expensive purchase isn't just about money spent today. It represents a specific setback in your timeline to freedom. Conversely, an increase in your savings rate or investment returns can accelerate your progress in quantifiable ways. True wealth builders embrace this systematic approach because it transforms the abstract concept of financial freedom into a series of achievable steps. They recognize that freedom isn't achieved through hope or general financial good behavior. It's the result of deliberate actions taken according to a well-engineered plan. By starting with the end goal and working backward, they create a detailed roadmap that guides every financial decision and keeps them moving steadily toward their vision of freedom. Chapter 4. They forecast, then act. Successful wealth builders understand that financial forecasting isn't about crystal balls or perfect predictions. It's about creating an informed framework for decision-making. They recognize that, while no one can predict the future with absolute certainty, developing the skill to make reasonable projections based on available data and trends is crucial for long-term wealth creation. The foundation of effective forecasting begins with honest self-assessment. Smart investors take time to analyze their current financial position, including income, expenses, assets, and liabilities. They examine their historical patterns, looking for trends in spending, saving, and investment returns. This baseline understanding becomes the launchpad for projecting future scenarios. These wealth builders then layer in external factors that could impact their financial trajectory. They consider economic indicators, market cycles, industry trends, and technological disruptions. But rather than becoming paralyzed by the complexity of these variables, they focus on identifying the most significant factors that could affect their specific situation and goals. What sets successful forecasters apart is their ability to create multiple scenarios rather than single-point predictions. They develop best-case, worst-case, and most likely scenarios for their financial future. This approach helps them prepare for various outcomes while maintaining flexibility in their strategies. When market conditions shift or unexpected events occur, they can quickly identify which scenario is unfolding and adjust their actions accordingly. The real power of forecasting emerges when it's coupled with decisive action. Smart wealth builders don't get stuck in analysis paralysis. They use their forecasts as a foundation for creating specific, time-bound action plans. These plans include clear triggers for when to buy, sell, or hold investments, when to pursue new income opportunities, and when to adjust their wealth-building strategies. They also understand the importance of regular forecast updates. Rather than treating projections as static documents, they review and refine their forecasts quarterly or annually, incorporating new information and lessons learned. This iterative process helps them develop increasingly accurate projections over time, while maintaining adaptability to changing conditions. One of the most valuable aspects of forecasting is its ability to prevent emotional decision-making. By establishing clear parameters and decision triggers in advance, wealth builders can avoid making impulsive choices during market volatility or economic uncertainty. Their forecasts serve as an objective reference point, helping them stay committed to their long-term strategy even when short-term conditions feel uncertain. Successful forecasters also recognize the role of leverage in their projections. They calculate how different forms of leverage, whether through debt, technology, or human capital, can amplify their results. However, they remain mindful of the associated risks and include appropriate safeguards in their plan. The most sophisticated wealth builders take their forecasting beyond pure numbers. They integrate qualitative factors such as technological advances, demographic shifts, and evolving consumer behaviors into their projections. This holistic approach helps them identify emerging opportunities and potential threats before they become obvious to the broader market. Throughout the forecasting process, these people maintain a healthy balance between optimism and realism. While their projections are ambitious enough to motivate action, they remain grounded in mathematical probability and historical precedent. This balanced perspective allows them to pursue aggressive growth while maintaining the discipline necessary for long-term wealth creation. Chapter 5. They invest in what compounds. The most powerful force in wealth building isn't timing, talent, or even tenacity. It's compound growth. The wealthy understand this principle intimately and structure their investments to harness its extraordinary potential. While others chase quick returns or the latest investment fad, successful wealth builders focus on assets that compound reliably over time. Compound growth occurs when your money makes money, and then that money makes more money. This exponential progression starts slowly but builds tremendous momentum over time. A single dollar invested at 10% annual return becomes $1, 10 cents after 1 year, hardly exciting. But after 30 years, that same dollar grows to $17.45, having multiplied itself more than 17 times. This mathematical principle works tirelessly in your favor, but only if you give it two critical ingredients: time and consistency. The wealthy select their investments through this compounding lens. They gravitate toward assets that not only appreciate but can reinvest their earnings automatically. Dividend-paying stocks that reinvest distributions, rental properties that generate cash flow for additional property purchases, and businesses that can reinvest profits for expansion all exemplify this principle. These assets create a snowball effect, where each cycle of returns builds upon the previous one. However, many people inadvertently interrupt their compound growth by making three common mistakes. First, they invest in assets that don't truly compound, like luxury cars or expensive jewelry that depreciate over time. Second, they frequently move money between investments, resetting the compounding clock with each change. Third, they withdraw earnings prematurely instead of allowing them to fuel further growth. Smart wealth builders also understand that compounding extends beyond just financial returns. They apply this principle to knowledge, relationships, and skills. Reading one book leads to insights that enhance the value of the next book. Each business connection opens doors to new opportunities. Every skill mastered becomes a foundation for learning related abilities. This comprehensive approach to compounding creates a multiplier effect across all aspects of wealth creation. The timeline for compounding is equally crucial. The wealthy start early and maintain a long-term perspective. They recognize that the real magic of compound growth happens in the later years, when the accumulated returns begin generating substantial gains of their own. This understanding helps them resist the temptation to harvest returns too early or switch strategies based on short-term market movements. To maximize compounding, successful investors also focus on tax efficiency. They understand that taxes can significantly erode compound returns, so they utilize structures like retirement accounts, tax-advantaged investments, and strategic asset placement to minimize this drag on their wealth accumulation. They view tax planning not as an afterthought, but as an integral part of their compounding strategy. Another key aspect of compound investing is reinvestment discipline. The wealthy automatically reinvest earnings rather than spending them. They understand that each dollar removed from the compounding cycle represents not just its current value, but all its potential future growth. This mindset helps them maintain the discipline required for long-term wealth accumulation. The selection of compounding vehicles also requires careful consideration of risk and reliability. While higher returns compound more quickly, they often come with greater risk of interruption or loss. The wealthy seek a balance, focusing on investments with reasonable returns that can be sustained over long periods. They prefer consistent 8–10% annual returns that compound reliably over volatile investments that might offer higher returns but risk breaking the compounding chain. Real wealth builders treat compound growth as their most loyal employee, one that works 24/7, never takes vacation, and becomes more productive with each passing year. They structure their entire investment approach around protecting and maximizing this powerful force. By understanding and applying the principles of compound growth, they create a self-reinforcing cycle of wealth that grows stronger and more effective over time. Chapter 6. They plan beyond retirement. Traditional retirement planning often focuses on a single milestone, having enough money to stop working around age 65. But wealthy people understand that true financial planning extends far beyond this oversimplified endpoint. They recognize that retirement isn't a finish line. It's merely one phase in a broader wealth strategy that spans generations. Smart wealth builders approach their financial future with a more comprehensive perspective. They consider how their assets will grow, transform, and transfer not just through their working years, but through their entire lifetime and beyond. This longer-term view influences every decision, from investment choices to business succession planning to estate structuring. The most successful wealth creators understand that money serves different purposes at different life stages. During working years, it primarily functions as a tool for growth and accumulation. In traditional retirement, it shifts to providing steady income and stability. But beyond that, it can become a powerful mechanism for impact, legacy, and family prosperity. This multi-phase approach requires different strategies, vehicles, and protections at each stage. Many people make the mistake of focusing solely on accumulating a specific retirement number without considering how that capital will be deployed and preserved over decades. Smart wealth builders instead create dynamic systems that can adapt to changing circumstances, market conditions, and family needs. They establish trusts, family investment companies, and other structures that can outlive them while providing sustainable benefits to future generations. This extended timeline thinking naturally leads to more sophisticated estate planning. Rather than waiting until late in life, wealthy people begin structuring their affairs early to minimize tax implications and maximize the efficient transfer of assets. They carefully consider how their wealth will be managed and distributed, often creating detailed governance structures to guide future decisions. The post-retirement identity also plays a crucial role in extended wealth planning. Wealthy people recognize that their relationship with money evolves as they move beyond their primary earning years. Many maintain active involvement in investment decisions, mentor younger family members in wealth management, or channel their expertise into philanthropic endeavors. This continued engagement helps preserve both financial and human capital across generations. Education becomes a cornerstone of multi-generational wealth planning. Smart wealth builders invest time and resources in preparing their heirs to become responsible stewards of family assets. They create systems for transferring not just money, but also values, wisdom, and financial literacy. This might include family councils, regular financial education sessions, or supervised practice in investment management. Assets are strategically positioned for different time horizons and purposes. While some portions of wealth are structured for current income needs, others are invested for growth decades into the future. This layered approach allows for both immediate security and long-term appreciation potential. It might include a mix of traditional investment vehicles, private equity holdings, real estate portfolios, and business interests, each serving specific roles in the extended wealth strategy. Risk management takes on new dimensions when planning beyond retirement. Wealthy people implement sophisticated insurance strategies, legal structures, and diversification approaches to protect assets across multiple generations. They consider factors like longevity risk, long-term care needs, and the potential impact of future tax law changes or economic shifts. The most successful wealth builders recognize that planning beyond retirement isn't just about preserving wealth. It's about creating systems for sustained growth and impact. They build frameworks that can adapt to changing circumstances while maintaining core principles of sound financial management. This comprehensive approach ensures that their wealth continues to serve its intended purposes long after traditional retirement age, creating lasting value for families and communities. Chapter 7. They leave room for luck, but don't rely on it. Smart wealth builders understand a fundamental truth about success. Luck plays a role, but it's not the starring character in their financial story. They recognize that what others often call luck is actually the product of preparation meeting opportunity. The key lies in creating conditions where good fortune can find you, while building a foundation solid enough to withstand bad luck when it inevitably arrives. Consider how venture capitalists approach their portfolios. They know that most investments will yield modest returns or fail, but they position themselves to capture outsized gains when extraordinary opportunities emerge. This isn't gambling, it's strategic positioning. Wealthy people apply this same principle across their financial lives, maintaining enough stability to weather downturns while preserving capacity to seize unexpected opportunities. The concept of anti-fragility, coined by Nassim Taleb, perfectly describes this approach. Anti-fragile systems don't just survive chaos, they get stronger from it. Smart wealth builders create anti-fragile financial structures by maintaining healthy cash reserves, diversifying their investments, and avoiding excessive leverage. When market turmoil strikes, they have the resources to acquire assets at discount prices while others are forced to sell. This preparedness extends beyond mere cash positions. It includes building valuable relationships, developing multiple skills, and staying informed about emerging trends. When the next economic shift occurs, these people aren't just hoping for good luck. They've positioned themselves to recognize and capitalize on opportunities that others might miss. They understand that luck favors the prepared mind, as Louis Pasteur famously noted. The balanced approach to risk is crucial here. While some investors swing for the fences with every decision, hoping to get lucky with a massive winner, successful wealth builders take a more nuanced approach. They allocate most of their resources to proven strategies while reserving a portion for higher risk, higher reward opportunities. This creates space for exponential gains without risking the core wealth foundation they've built. Consider the story of Sarah, a software engineer who maintained a 6-month emergency fund while her peers invested every spare dollar in tech stocks during the boom years. When the market crashed in 2020, she had the capital to purchase shares in solid companies at steep discounts. What looked like lucky timing to others was actually the result of deliberate preparation. Smart wealth builders also understand the role of negative luck or misfortune in financial planning. They build redundancies into their wealth strategy, knowing that setbacks are inevitable. This might mean maintaining multiple income streams, holding insurance policies, or structuring investments to limit downside risk. They don't pray for good luck, they prepare, both good and bad scenarios. The relationship between luck and skill often gets misunderstood. Skilled investors don't try to predict exactly when opportunities will arise. Instead, they create systems that allow them to recognize and act on opportunities quickly when they appear. They maintain decision-making frameworks that help them evaluate potential lucky breaks objectively, rather than being swayed by emotion or FOMO. This approach to luck extends to network building as well. Successful wealth builders cultivate relationships not just for immediate gain, but to create a web of connections that might yield opportunities in the future. They share their knowledge, help others, and build goodwill, knowing that this social capital often delivers returns in unexpected ways. The ultimate paradox of luck in wealth building is that the more thoroughly you prepare, the luckier you seem to get. By maintaining financial flexibility, staying informed, building strong networks, and keeping powder dry for opportunities, you create an environment where good luck becomes more likely and bad luck less devastating. The goal isn't to rely on luck, but to be ready when it arrives. Chapter 8. They focus on time, not timing. The most successful wealth builders understand a fundamental truth. Time in the market beats timing the market. While many investors waste countless hours trying to predict the perfect moment to buy or sell, the truly wealthy focus on maximizing their time horizon and letting their assets work over extended periods. This principle becomes crystal clear when we examine the historical data. Studies consistently show that investors who attempt to time the market typically earn returns far below the market average. Even professional money managers, with all their sophisticated tools and analysis, rarely succeed at market timing over the long run. The reason is simple. Perfect timing requires two impossible predictions, knowing exactly when to exit and exactly when to re-enter. Smart wealth builders take a different approach. They recognize that wealth creation is not about catching the perfect wave, but about staying in the ocean. They understand that the market's long-term trajectory has historically been upward, despite periodic downturns and volatility. Instead of trying to dodge every market dip, they position themselves to ride through the turbulence while keeping their focus on the distant horizon. This focused mindset manifests in several practical ways. First, these investors start as early as possible, understanding that each year of delay represents a lost opportunity for compound growth. They know that an investor who starts at age 25 and invests consistently for 40 years will likely accumulate significantly more wealth than someone who starts at 35, even if the latter invests larger amounts. These wealth builders also maintain discipline during market volatility. When others panic, sell during downturns, they stay invested, often increasing their positions when assets are temporarily discounted. They view market corrections not as disasters, but as natural parts of the economic cycle, opportunities to acquire more of what they already believe in at better prices. Dollar-cost averaging becomes a cornerstone strategy for time-focused investors. Rather than attempting to identify the perfect entry point, they invest fixed amounts at regular intervals, regardless of market conditions. This approach removes the emotional burden of timing decisions while ensuring consistent participation in the market's long-term growth. The time-focused approach extends beyond just investment strategy. These people apply the same principle to their businesses and careers, focusing on building sustainable value rather than chasing quick profits. They understand that truly valuable enterprises and skills are developed through years of consistent effort, not overnight success. Technology and instantaneous trading have made it more tempting than ever to try timing the market. But smart wealth builders resist these distractions. They know that checking portfolio values daily or making frequent trades based on news headlines or market sentiment is more likely to harm than help their long-term results. Instead, they automate their investment processes and review their portfolios quarterly or annually, making adjustments based on their long-term strategy rather than short-term market movements. The most sophisticated wealth builders take this concept even further by creating time-leveraged positions. They structure their investments and businesses to benefit from the passage of time itself, whether through compound interest, appreciation of assets, or the growing value of intellectual property. They seek opportunities where time naturally works in their favor rather than against them. This focus on time over timing also helps wealthy people maintain better mental health and life balance. Instead of being glued to financial news or trading screens, they can direct their energy toward their careers, relationships, and personal growth. They sleep better at night knowing their wealth-building strategy doesn't depend on their ability to predict the unpredictable or react to every market movement. Time, not timing, is the most powerful force in wealth creation. The wealthy understand this principle deeply and structure their entire approach to financial success around it. They know that sustainable wealth is built through patience, consistency, and the intelligent use of time as an ally in their wealth-building journey. Chapter 9. They buy what makes money. Smart wealth builders understand a fundamental principle that separates them from the average consumer. They purchase assets that generate income rather than items that drain resources. This mindset shift transforms their relationship with money and accelerates their path to financial independence. The wealthy approach buying decisions through the lens of return on investment. When considering a purchase, they first ask, will this asset work for me and generate more money? This question guides them away from depreciating consumer goods and toward productive investments. Whether it's rental properties, dividend-paying stocks, or business equipment that increases productivity, their purchases are strategic moves designed to strengthen their financial position. This doesn't mean they never enjoy luxury items or personal purchases. Instead, they establish a clear hierarchy. Income-producing assets come first, and lifestyle upgrades follow only after their wealth-building machinery is running smoothly. They understand that every dollar invested in a productive asset has the potential to create hundreds or thousands more over time, while money spent on consumer goods typically represents a permanent exit of capital from their wealth-building system. The sophisticated wealth builder also recognizes that not all money-making assets are created equal. They evaluate potential purchases based on factors like cash flow potential, maintenance requirements, scalability, and market demand. A rental property might generate steady monthly income, but require significant management attention. A software business might need minimal ongoing maintenance while producing substantial recurring revenue. These considerations inform their buying decisions and help them build a portfolio of assets that aligns with their skills, interests, and lifestyle goals. Another crucial aspect of this approach is the focus on assets that appreciate or maintain value while generating income. For example, a well-located commercial property might provide rental income while also increasing in value over time. Quality businesses often appreciate as their customer base and revenue grow. This dual benefit, current income plus long-term appreciation, creates a powerful wealth-building engine that works around the clock. Smart investors also understand the importance of timing and market cycles when making significant purchases. They don't chase trendy investments at peak prices, but look for value opportunities where they can acquire income-producing assets at reasonable prices. This patience and discipline often allow them to buy quality assets during market downturns when others are selling in panic. The wealthy also leverage their existing assets to acquire more income-producing investments. They might use the equity in one property to finance the purchase of another, or reinvest business profits into expansion opportunities. This multiplication effect accelerates their wealth accumulation and creates a growing network of interconnected assets working in concert to generate returns. Education plays a vital role in this strategy. Successful wealth builders continuously learn about different types of income-producing assets and stay informed about market conditions and opportunities. They build networks of knowledgeable advisors and fellow investors who can provide insights and partnership opportunities. This knowledge base helps them identify promising investments and avoid costly mistakes. Perhaps most importantly, they maintain strict criteria for what constitutes a worthwhile purchase. They develop detailed analysis methods to evaluate potential investments and aren't afraid to pass on opportunities that don't meet their standards. This disciplined approach prevents them from making emotional decisions or being swayed by flashy marketing promises that could derail their wealth-building progress. Their focus on buying income-producing assets creates a self-reinforcing cycle of wealth generation. Each successful investment provides both immediate returns and the capacity to acquire additional productive assets. Over time, this approach transforms their financial reality from one of trading time for money to one where their money works tirelessly to create more wealth, regardless of their personal effort or presence. Chapter 10. Their blueprint includes protection. Wealth building isn't just about accumulation, it's equally about preservation. Smart wealth creators understand that protecting their assets is as crucial as growing them. They recognize that a single unfortunate event can wipe out years of careful planning and disciplined saving if proper safeguards aren't in place. The most successful wealth builders approach protection systematically, starting with the fundamentals of insurance. They maintain appropriate levels of life, health, disability, and property insurance, viewing these not as expenses but as vital shields for their wealth-building journey. They understand that medical emergencies, accidents, or natural disasters shouldn't derail their long-term financial goals. Beyond basic insurance, they implement sophisticated asset protection strategies. This often includes structuring their holdings through appropriate legal entities, such as LLCs or trusts, to separate personal and business assets. They work with qualified legal professionals to ensure their wealth is structured optimally for both protection and growth while remaining compliant with all relevant laws and regulations. Digital security also plays a crucial role in their protection strategy. As more wealth exists in digital form, they take cybersecurity seriously, implementing strong passwords, two-factor authentication, and regular security audits of their financial accounts. They stay informed about the latest security threats and take proactive steps to protect their digital assets. Smart wealth builders also protect themselves from market volatility through diversification. They spread their investments across different asset classes, sectors, and geographical regions. This diversification isn't just about maximizing returns, it's about ensuring that no single market event can devastate their entire portfolio. They understand that true diversification means having assets that respond differently to various market conditions. Another critical aspect of their protection strategy involves maintaining adequate liquid reserves. These emergency funds serve as buffers against unexpected expenses or income disruptions, preventing the need to liquidate long-term investments at inopportune times. They typically keep these reserves in low-risk, easily accessible accounts, separate from their growth-oriented investments. Documentation forms another layer of their protection strategy. They maintain detailed records of all important financial transactions, contracts, and agreements. They keep their estate planning documents updated, including wills, trusts, and power of attorney arrangements. This documentation ensures their wishes are clear and legally binding, protecting both their wealth and their loved ones. Regular review and updating of these protection measures is part of their routine. They understand that, as their wealth grows, their protection needs evolve. What might have been adequate coverage at one wealth level may be insufficient at another. They periodically reassess their insurance coverage, legal structures, and security measures to ensure they align with their current situation. The most sophisticated wealth builders also protect themselves from their own behavioral biases. They establish clear investment policies and decision-making frameworks that guide their actions during both good times and bad. These frameworks help them avoid emotional decisions that could compromise their wealth-building strategy. Protection strategies extend to their income sources as well. They diversify their income streams not just for growth, but for security. Multiple income sources provide resilience against job loss or business downturns. They continuously work to strengthen and stabilize these income streams, treating them as vital components of their wealth protection system. Smart wealth builders recognize that protection isn't just about defending against losses. It's about creating a foundation of security that enables bolder wealth-building moves. When they know their downside is protected, they can focus more confidently on upside opportunities. This balanced approach to protection and growth becomes a powerful catalyst in their wealth-building journey. Chapter 11. They refine their plan every year. The most successful wealth builders understand that a financial plan is never truly finished. It's an evolving document that requires regular refinement and adjustment. Like a captain navigating through changing waters, they recognize that conditions shift, opportunities emerge, and circumstances change in ways that demand responsive adaptation of their wealth strategy. These methodical wealth builders set aside dedicated time each year to thoroughly review their financial blueprint. They examine their progress, assess their assumptions, and analyze whether their current trajectory aligns with their long-term vision. This annual review isn't merely a casual glance at account balances. It's a comprehensive evaluation of every aspect of their wealth-building strategy. During these refinement sessions, they start by examining their core assumptions. They question whether their projected returns remain realistic, if their risk tolerance has shifted, and whether their timeline expectations still make sense given current market conditions and personal circumstances. They look for gaps in their strategy that may have emerged over the year and identify areas where their plan may have become outdated or inefficient. The refinement process also involves updating their knowledge base. Markets evolve, tax laws change, and new investment vehicles emerge. Smart wealth builders use their annual review to educate themselves about relevant developments in the financial landscape. They consult with advisors, read industry analyses, and stay informed about economic trends that could impact their wealth-building strategy. One crucial aspect of the annual refinement is performance measurement. They compare their actual results against their projected targets, but not to beat themselves up over shortfalls. Instead, they use this data to make intelligent adjustments to their approach. If certain investments or strategies aren't performing as expected, they investigate why and determine whether the underperformance is temporary or indicative of a need for strategic change. Life changes also factor heavily into the refinement process. Marriage, children, career shifts, health issues, or changes in financial goals can all necessitate adjustments to the wealth-building plan. Smart investors proactively modify their strategy to accommodate these life transitions rather than allowing their plan to become irrelevant or counterproductive. The refinement process extends beyond just investment strategy. They review their insurance coverage, estate planning documents, tax strategies, and risk management approaches. They ensure their wealth protection mechanisms remain robust and appropriate for their current situation. They also evaluate whether their income streams are performing as expected and look for opportunities to optimize or expand them. Technology and tools are another consideration during the annual refinement. They assess whether their current financial management systems are still serving them well, or if new solutions could help them better track, manage, and grow their wealth. They're willing to adopt new tools and platforms that can enhance their wealth-building efficiency. The most sophisticated wealth builders also use their annual refinement to scenario plan. They consider potential future challenges or opportunities and adjust their strategy to account for these possibilities. This might involve setting aside funds for potential opportunities, adjusting their asset allocation to better weather possible economic storms, or creating contingency plans for various scenarios. Through this systematic annual refinement process, their wealth-building strategy becomes increasingly sophisticated and resilient. Each year's adjustments build upon the lessons and experiences of previous years, creating a constantly improving approach to wealth creation. This commitment to regular refinement ensures their financial blueprint remains a living, breathing document that evolves alongside their life journey and the changing financial landscape. Chapter 12. They follow the map, not the mood. The distinction between successful wealth builders and those who struggle often comes down to a simple truth. The former follow their strategic map, while the latter follow their emotional moods. This disciplined adherence to a well-designed plan, regardless of market sentiments or personal feelings, creates the foundation for lasting wealth. Consider how emotions typically drive financial decisions. Fear prompts panic selling during market downturns. Greed leads to overextension during bull markets. Impatience causes abandonment of sound strategies before they have time to work. Anxiety triggers constant portfolio tinkering. These emotional responses, while natural, often directly oppose the behaviors that build sustainable wealth. The wealthy approach their financial journey differently. They recognize that their carefully crafted plan serves as their North Star, especially during turbulent times. When markets plunge, they consult their asset allocation strategy rather than their fears. When exciting investment opportunities arise, they evaluate them against their established criteria rather than succumbing to fear of missing out. This map-driven approach provides clarity amid chaos and confidence amid uncertainty. This commitment to following the plan extends beyond investment decisions. It influences spending patterns, saving rates, and business choices. A wealth builder might feel the urge to upgrade their lifestyle after a particularly profitable year, but their financial map reminds them to maintain their predetermined spending ratios. They might be tempted to divert funds from their business reinvestment strategy during a slow period, but their plan keeps them focused on long-term growth rather than short-term comfort. The map itself must be detailed and comprehensive to serve its purpose effectively. It should outline specific actions for various scenarios, including market corrections, personal emergencies, and economic opportunities. This level of preparation eliminates the need for reactive decision-making during emotionally charged moments. When the path forward is predetermined, following it becomes a matter of execution rather than deliberation. Yet following the map doesn't mean operating on autopilot. Smart wealth builders regularly assess their plan's effectiveness and make strategic adjustments when necessary. The key difference is that these adjustments stem from careful analysis rather than emotional impulses. They modify their course based on changing circumstances, new information, or evolving goals, not because of market headlines or water cooler tips. The wealthy also understand that their financial map must align with their personal values and lifestyle goals. This alignment ensures that following the plan feels natural rather than forced. When your wealth-building strategy resonates with your core principles, staying the course becomes significantly easier. You're not just following a set of rules, you're living according to your chosen path. Technology plays an increasingly important role in this map-following discipline. Automated investment platforms, spending trackers, and portfolio rebalancing tools help remove emotional decision-making from the equation. These systems execute predetermined strategies regardless of market sentiment or personal mood, providing a mechanical advantage in maintaining course discipline. Perhaps most importantly, successful wealth builders recognize that following their financial map often means going against the crowd. While others chase the latest investment fad or panic during market volatility, they stick to their established strategy. This contrarian positioning frequently feels uncomfortable, but historically proves profitable. The ability to maintain course while others deviate often represents the difference between building lasting wealth and experiencing temporary gains. The ultimate power of following the map lies in its compounding effect over time. Each decision to stick to the plan rather than succumb to emotional impulses adds another brick to the foundation of wealth. These consistent, disciplined choices accumulate not just financially, but also in terms of developed wisdom and strengthened resolve. The map becomes not just a guide, but a source of growing confidence in one's ability to build and maintain wealth regardless of external circumstances.